Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Special guest, John. He's called Jamie Dimon. He runs JPMorgan, and I'm delighted to speak to him. Jamie Dimon, thank you for joining us.
Francine, happy to be here.
Hey, there's a lot going on. It's trade wars, markets up and down. What did you learn in the last month?
Not much, other than we have all this uncertainty. You know, some preceded the new administration, like we had large deficits, interest rates going up, inflation going up, and some are, tariffs and things. And of course, the geopolitical situation is very tense, very difficult, and hard to resolve.
Okay, so if you forget projections, numbers, what's your hunch? Is the U.S. going to go into recession or not?
Look, I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at, the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, to have an engaging conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so, there's a lot of uncertainty still. And there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, do vote or something like that. And so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect immediate resolution, to the satisfaction of everybody in 90 days.
But you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up at any second?
Markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. War in Ukraine, terrorism in the Middle East, Iran, huge deficits, our tax bill, which I would like to see a good tax bill pass. The tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate, and I think they have a chance to actually develop a great relationship, partially making up for, the disaster that Brexit became. And those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't. And volatility could be good or bad depending on who's facing it. So, but I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will calm down.
Has it been good for JPMorgan? What's your trading revenue looking like?
Yes, because when there's volatility, this is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go around may not be so good.
Jamie, when it comes to financials, a lot of, non-bank entrants are making quite a lot of way. Citadel, Jane Street. Is that a concern for the banks? Should it be a problem for the banks?
I wouldn't call it a problem. They're both clients and very capable. But I've always had the view there are a lot of competitors out there, and all the major banks are back. I think that's a good thing for the world. Maybe not so much for JPMorgan. You mentioned those two. There's Apollo. There's a lot of fintechs, some very good ones. There's Stripe. There's PayPal. Yeah, my view has always been the same. I tell the management team, assume competition. Assume they're coming at you in every angle. Assume they often have their own strengths, sometimes their own weaknesses. They won't all do great, but yeah, I think they're, some of these people are gaining quite a bit of share in parts of their business. We still are too, by the way. So, we're in the fight. We're not losing out very much, but that doesn't mean you won't lose out tomorrow because you're winning today.
So what do you have to do today? How do you see the people that are doing, well today doing even better tomorrow?
Are you talking about us or other people?
Both.
It's quality people. You interviewed Pranav. We have exceptional people in investment banking and sales and trading. And I put right next to that technology, but it's related because those people deploying technology. So there are thousands of technology projects, and then there are hundreds of AI projects, all of which are meant to do a better job for customers, consumer, research, how we deliver things to people. And if you don't move, you're going to be left behind. I mean, I remind you, you could be a country or a company, you do not have a divine right to success. We mentioned this management learning things I did. You can see it on YouTube and all that. But I point out to people, look at the bank, look at Nokia, BlackBerry, Sears, Kmart, Bear Stearns, Lehman. I can chapter up the verse of failed companies, usually because they're complacent, arrogant. They think they're, on the top of the, top of the world, and they're not. There are competitors coming everywhere, and you should assume that's going to be true.
Do you see competitors coming for the U.S.?
Yeah.
Where? Europe?
Oh, you're talking about the countries?
The countries, yeah.
Yeah, I think Europe. Let me just say this. I think Keir Starmer, Merz, and Macron. I think Macron is one of the best political leaders on the planet today. Okay. I think Keir Starmer is smart, devoted. They're saying the right things public and privately. All of them talk about growing the economies. Thank God. Pro-business, pro-capital. And they're doing all that to improve the lot of their citizens. It's not about what they're doing for JPMorgan. And if I was Europe, absolutely, I'd want to greatly live in the UK, military, economic, and I would reform as best I can all of European things, what they're all talking about now, deregulation, simplification, and yeah, they try to compete with America, and that would be good for America. That doesn't make me sad. It makes me happy that they're strong. And then, they're allies. I want our allies to be strong and powerful, militarily and economically.
But do you worry about U.S. supremacy, actually? Exceptionalism?
Yeah, I never believe we're quite that exceptional. I mean, remember, America's an unbelievable country with freedoms and the gifts of God and, water, food, energy, and then the gifts of the founding fathers called freedom of religion, freedom of speech, freedom of enterprise. Those dwarf everything. And so we still have the most prosperous economy the world's ever seen, but the Americans shouldn't take it as a divine right to success either. We've slowed ourselves down with regulation, stupid bureaucracy. We haven't done budgets in years, so no, we shouldn't assume it's forever. I don't think we'll still be preeminent, militarily and economically for a long time, but if we don't do everything right, we can lose that too, 20, 30, 40 years from now. And I think very important to that is America. The goal of America should be to help the military alliances of the Western world and to help the economic alliance of the Western world to walk side by side like you did in Victory in Europe Day the other day here, to strengthen the Western world and hold it together, not to cause it to fragment. And so I think we have to work hard to make sure that's the case.
Do you worry about deficits, and do you worry actually in the U.S., and do you worry also about the U.S. dollar remaining as a reserve currency? Do you think Europe has what it takes to try and put the euro in there?
Yeah, so I should have mentioned deficits up front as being one of the issues you have to deal with. And I think asset prices are quite high too, and those create various risks for America. Our deficit is almost $2 trillion, 6 or 7% of GDP, the largest peacetime deficit ever, and we have 100% debt to GDP. That 100% debt to GDP is kind of universal, almost around Europe on average, but your deficits are much smaller. Does that create a risk? Absolutely. It creates a risk of inflation to me. It creates a risk of higher long-term rates. But America, will the dollar get weaker? I don't know. That's a slightly different thing. I think you could see rates go up, the long bond rates go up, and that might slow down the growth, and that's how we kind of a stagflation kind of scenario.
What do you you must see President Trump regularly. What do you tell him? What would you tell him?
I talked to all of the folks there. I wrote about my chairman's letter. I mean, first of all, America should worry about things we can do better. I call it blue tape. I mean, we are out of control. We're doing the same stuff that they did here that, virtually, the American public may not know. The GDP per person in Europe has gone from something like 90% of Americans to 65%. And they did it to themselves. Rules, regulations, overcomplication. They started the European Union, which I think is a huge accomplishment of mankind. They got to finish it. And here they call it the Capital Markets Union, the Banking Union. They have to create a big common market of 450 million people. And so in America, it's the same thing. It's regulations, it's permitting. We've wasted a lot of money in the green economy. It's getting jobs back. It's training in schools. It's fixing immigration. So we've stopped at the border, but now we have to have a more merit-based immigration, more seasonal immigration. Things that can help the country grow. And then we have to work on our military alliances, on our economic alliances. And that's for the sake of the future free and democratic world.
But so on the economic alliances, is there a concern that actually certain countries in Europe or elsewhere will choose non-U.S. bank for bond issuances, will choose non-U.S. asset managers to manage their pensions?
Yeah, there'll be a little of that. We irritate a lot of people. So I run into them, they say, like they're not buying our, Kentucky bourbon or something like that. There'll be some of that. And I think it's perfectly reasonable for, I spoke to a lot of investors here. They're thinking about the asset allocation to the United States. Will they diminish that? Possibly. Is America a bad investment destination? No. If you were to take all of your money and put it in one country, it would still be America. I mean, it's still the most prosperous nation on the planet. It's got the best military on the planet. It's got huge amounts of innovation. People are catching up. That's a good thing. China's doing some very good innovation in medical and AI, and we should assume they're going to continue to do that. But America's still got the best. Our GDP per person is $85,000. China's $15,000. We don't have anything to be ashamed about. We should fix our problems because we could grow a lot faster, which help all of our citizens.
But if you put out too many tariffs and actually too much uncertainty, does that not squander actually a lot of the assets that the U.S. has?
A little bit. I mean, I think they're doing the right thing now, which is to back off of it. Let the Secretary of Treasury do the hard work of figuring out what's the right thing to do. If there are unfair trade things, do something about it. But they have backed off of specific things in specific industries, and I think that's the right thing to do. I think the first thing was very large, kind of that everything, everywhere, all at once, and now they're, kind of backing to where I think they should be.
In terms
but even at this level, it causes that kind of uncertainty. Even at this level, you see people holding back on investment and thinking through what they want to do. Thinking about how much you're going to put in the United States, and I mean, we're going to be okay, but it is causing that uncertainty.
We were looking at the president, of course, in the Middle East, where there were deals that were signed, and a lot of Wall Street, some of your competitors there. What's your strategy for the Middle East? How much do you want to grow there?
Well, we grow everywhere. I mean, we go country by country, and we look at, we bank countries, cities, schools, states, hospitals, big companies everywhere. We have a network effect. So when we bank Bloomberg, we're banking you in the United States, we're banking you in London, we're in Paris, we're banking you in Europe, we're banking you in the Middle East. That's what we do. So almost every one of those countries, we're growing. As they grow, we grow. We cover, more of their institutions. Overseas, we're institutional. In the United States, we also have consumer. And so, as you know, we're testing consumer in Chase UK.
Yeah, and you're growing actually that retail business a lot in the UK. What's next for that?
We hope to grow it more in the UK, add some products, and eventually we've already announced we're going to go to Germany. But I think we have a chance to build a great digital bank, and we have competitive advantages. Yep. We have a brand, we have research, we have a balance sheet, we've got capabilities. We're going to add, we're not going to announce it today, we're going to add more capabilities over time, so that, and then someone like you, if you travel to the United States and to the UK, you're going to be able to move your money between Chase US and Chase UK on your phone. So we're going to add things that make your life better as a consumer of our banking product.
You certainly caused some waves in talking about return to the office. I think there might have been a little bit swearing.
I emoted a little bit,
in there, or not. Have people listened?
Yeah.
Has your staff
we're back
full time?
Listen, first of all, I did emote there. I emote, people know me, and I don't really care about that. I don't worry about it. But I want to answer the guy asked a legitimate question, and I gave it a very detailed answer about why it doesn't work for young people, why it doesn't work for management, why it doesn't work for innovation. I completely applaud your right to not to want to go to the office every day, but you're not going to tell JPMorgan what to do. And I think we already have 10% of jobs at home. I'm not against work from home. I'm against work from home. It doesn't work. And then, of course, the press made a big deal about the petition and all that. It was like not even mosquito.
Okay.
Most people are back. Some people, we've had no additional attrition. We had to make some modifications. We didn't have enough seats in certain areas, and we'll be a better company. And I think our employees will be happier over time. And the younger people learn the right way. It's an apprenticeship system, and you can't learn working from your basement.
Jamie Dimon, thank you so much for joining us today. That was, of course, the Chief Executive Officer of JPMorgan.
Jim Zelter, the president of Apollo Global Management, weighing in on the administration's trade regime the last time he joined us, saying this: globalization is not going to be like we have seen it in the past. It is a new global world order. I'm pleased to say for the next 30 minutes, Jim Zelter joins us this morning. Jim, good morning.
Good morning.
There's a phrase you used last time around that stuck with both of us. We've been repeating it over the last several weeks: macro paralysis.
Can you adjust that term now? What phrase would you use to describe this moment?
First of all, it was good to be here. I think I would frame it right now as a macro political pivot. The administration, clearly, I agree. I think that Monday meeting with the retail executives was I don't want to call it watershed, but it was a critical moment for the administration to hear about the challenges on the ground of their plan. And the administration certainly has not admitted they made a mistake, but they've clearly pivoted. And that's not a surprise, and it's not a surprise that they're out going around the globe right now trying to and successfully inking a lot of deals, a lot of MOUs that are non-binding, but certainly it's great headlines, and it's hundreds of billions, if not trillions. But so that's where I think the big question now is, I'll pull back in the COVID library. There's a big gap between confidence, sentiment, and the results. And confidence and sentiment is still pretty negative or concerned, but the results have been pretty strong. And so there's a very, if you think about, we're all, history of the past, and we see signs of what we've seen in the past, and pattern recognition, if you will. And, if you input all the things that you see right now, you would have been saying recession went from 30% to 70, 80%. Now it's probably below 50%. But the three questions are, does the consumer, do corporates and countries, are they going to be on the V-shaped recovery, the U-shaped recovery, or the L-shaped recovery? Our view at Apollo is right now that the consumer is still pretty strong, a bit of a V-shaped recovery. Corporate's a bit of a U-shaped recovery because a lot of CapEx. And I've been traveling around quite a bit, and I think the global response is a bit more like the L. And what you pointed out earlier, what Anne-Marie did with Tim Cook, I am not surprised. None of us should be surprised that this administration is going to put their arm around all of these tech titans and other leaders and saying, come to America. China was not the plan. We didn't love the idea of going to India. Come back to the U.S. This is going to be a theme that they're going to keep hitting.
Is there enough of a framework that you're gleaning from this administration that's solid to bring deal making back? We've seen on the margins some deals being made, some IPOs. There are just a few. Is this the beginning?
Well, I think let's separate the headlines from activity. It's been an incredibly active time for folks that have been involved in the markets. We at Apollo, we opened up the IPO market. We brought out Aspen, one of our reinsurers, for an IPO. We did a multi-billion-dollar deal for Lottomatica, IGT Every. We announced a big merger between New Home and a Land and Sea. So there's been a lot of transactions since April 2nd. I know the headlines may show contrary, but there's been a tremendous amount of financing, and I think it shows the depth and breadth of the markets right now because of private capital in the equity and the credit world. So this idea that the market shut down, that's actually what happened 2 decades ago. 2 decades ago, the high yield market would go into periods 6, 8, 10 weeks where there would be no issuance based on the flows from retail, the old AMG numbers. So this economy, this capital markets is very robust. Obviously, a lot of volatility. One of the benchmarks in our market would be HYG, the high yield index, the listed HYG ETF. That went from basically 79.80 down to 73, 74, back to 79. It's been a round trip, but there's been a tremendous amount of activity underneath the headlines.
How much do you think this is because people see the environment as being brighter than some may worry? And how much do you see this as just simply pent-up demand that's been backed up for a long time? There is this sort of cyclical move toward industrialization, and you have that kind of fundraising that is kind of independent of any economic cycle.
I think the bigger long-term trends of massive CapEx, the year or two of CapEx, global industrial renaissance, the demographics, every asset class is higher today as we sit here this morning than it was on Liberation Day, except for treasuries, which have 10-year basically 30 basis points higher, and the 30-year about 40 basis points higher, about 5, 15, and 6% respectively. That's telling you that folks think that the economic backdrop is not going to be a recession. It's going to be slow to moderate growth, and that's what you're seeing right now in the market. So that's what we're seeing from our companies. We're seeing a lot of concern, a lot of hand-wringing about big strategic M&A transactions. I don't think you're going to see a massive equity calendar except for a few few large deals here and there. But the reality is companies need to operate, finance, and grow, and they're positioning themselves for an environment that the administration's putting forth.
This is what companies need. Let's spend some time talking about what investors need. Never mind the rebound. What did you learn from the drawdown, public versus private?
Well, what you saw is that I come up here a lot and talk about market structure, and what you're finding right now is that longer dated capital, is us and many of our peers have long dated insurance assets. Those were the folks that were the most active during the marketplace, and they were a bit of the buffer, if you would. You know, we put about $27 billion to work in the IG market from April 2nd to last week. That's on a gross basis, about 17, 18 billion. I think in the past, that participant was not in the market as much, and the buffer from the Wall Street bank trading desk taking that balance, I think that we collectively as an industry helped out. So you didn't see as much volatility. There's a lot of cash on the sidelines. There's a tremendous amount, and again, as you see what's going on right now around the globe with, you know, the pension assets, DC assets, other assets, really trying to get long duration assets against their liabilities, it's really, really critical. I mean, the one big overhang that's still in the market is what's going on in the Treasury market. You know, certainly if you pivot right now to what's going on with the budget issues in DC, it doesn't look like they have a clear path to a deal that would be really deleveraging to the U.S. over time. Now, Besson is saying a lot of great things, but Treasury rates are higher, and you know, as we've been saying, the one real left tail risk for this administration is the Liz Truss moment. Is that still out there? It's not a zero. It's not a big number, but it's a left tail risk for this administration.
Can we ask you what you think that looks like? What does a Liz Truss moment look like in the Treasury market?
You know, it's the deepest, most liquid, broadest market in the world, and I don't really participate day to day, so I'm not. It's a confidence issue, and it's when that stream of confidence goes from not being substantial to being a little bit more material, and I don't know what that number is, but certainly it's got to be in the back of the head of the administration. And again, the prior administration did not really extend duration in their liabilities. So there's I don't know if it's 7 or 9 trillion of refinancing over the next 24 months. It's a big number. But these rates are real. Rates are real in terms of where they are right now. So you are finding buyers of that paper, but it is a challenge in the backdrop.
There is this belief that private credit markets offer this ballast, this sort of haven from some of the volatility that we're seeing in public markets, and in particular from the Treasury market. At the same time, how can you say that private debt in particular is really immune to the fluctuations and the sucking sound of capital into the Treasury market, given all of that issuance?
Well, I'd say two things, and this is a longer conversation that I do want to get into. The real rates are higher, and if you can in private credit, you know, high single digits, low double digits on a compounding basis, it's a tremendous asset class over a decade or two. I really want to spend some time with you both this morning talking about, you know, these comments about private credit being a bubble. You know, that's just a mistaken comment, and when you really break it down, as I said before, private credit in the traditional manner, the narrow manner, is the high yield market, the leveraged loan market, and now the emerging direct lending market. When people talk about a credit bubble, it's just not the case. What they are talking about is there could be a credit cycle. That's normal. We haven't had one in a long time, but that credit cycle will impact debt and leveraged balance sheets, high yield, leveraged loans, and direct lending. It'll also affect private equity. It'll affect equity multiples, but it's not a bubble per se. It's a good old recession and a credit cycle. We're going to have one of those. It may be pushed out again a year or two, but let's not go out there. I think folks that are not in private credit or private capital say, oh, it's a bubble because they're not involved. But the reality is there's lots of opportunities. There's a massive amount of opportunities. We were very active last month. Boeing decided to spin off its aircraft, one of its businesses. We worked in conjunction with Citi on it. Multi-billion-dollar deal, a tremendous asset, heated auction. There's opportunities for real companies, but there will be a credit cycle.
It's always a bubble when you're not invested in it, right?
I love that.
Isn't that the takeaway?
Yeah, basically. If you don't like it, it's because you're not in it, and so too bad for you.
Jim, we talked about the prospect of a credit cycle. How can we have a credit cycle when we're running deficits this large in Washington?
Well, I mean, as I said before, we've been waiting for those who have been professionals in this sector for decades would have expected a few things right now. And I've talked about pattern recognition. I was here several years ago talking about the rate hike and how that would create a period of tighter financial conditions. And many of us that were expecting a serious credit cycle, predicted something that didn't occur because of the macro backdrop. Certainly right now, as we have a higher rate environment, which means a bit of economic strength in the overall economy, there always are a number of companies that just have too much leverage and are not going to grow out of their balance sheets. And you're going to see that. Last couple of years, you had actually fairly high numbers of restructurings in non-investment grade credit. It just didn't overwhelm the headlines because of the overall returns and the strength of the equity market. But I do think there are, as I said before here, when you look back at the last 4 or 5 years in private credit direct lending, a lot of the largest sector of financing was technology and enterprise software. And I do think that there's a possibility with what's going on with AI that many of these companies could really have massive impact on their operating business. The renewal rates that are 80, 90, 95% could plummet dramatically. And I could see a variety of challenges in the enterprise software tech space that have been a big area of private credit. And I think there will be those who are not involved will say, aha, there was a problem, it's a hoax. That's not the case. It was just bad companies, over-levered, that didn't grow out of their balance sheet. And that happens every day in the equity market and other markets. But, as much as we are a player in the insurance balance sheets on safe yield, we also do play in that riskier end. And I don't see a massive credit cycle happening in 25. Certainly, we've taken care of a lot of the refinancing risks. That refinancing cliff that was pretty large in 26 and 27, it's been pushed out. But we're not seeing, although the risk premiums have been raised. And I will tell you, there's a very large U.S.-based retailer based here in New York that has undergone a transformational merger. They had a private credit solution in front of them, which we were quite involved with. They decided to go to the public markets and issue a public bond in the safe public markets. And that bond today, within 6 months, is trading below 50. So again, I think there's a lot of noise about risk and reward in various asset classes, but that's our view of private credit.
Just quickly, how much could higher long-term U.S. yields spur that credit cycle? I won't call it a bubble, because we could talk about what a bubble is or what what we could see with some sort of just negative price action. But do you see that as being a catalyst?
Well, I think that the overall, having higher real rates are good for long-term investors to a certain degree. They're good for a certain degree until we lose confidence in the actual underlying market. And again, the U.S. Treasury market, deepest, most liquid in the world, rates of 4.5% and 5% with real rates right now, pretty strong on a relative basis over the last 25 years. But I'm not seeing that in the current zip code.
Just to wrap it up, biggest opportunity right now for you and the team. What do you think it is?
Well, I think it's a few places. I do think the volatility that has taken most people on the sidelines in a bit of a paralysis, just operating day in and day out on the business that we do right now. We have $850 billion of capital, doing a lot of refinancing with PE firms. There's over 2,000 PE situations where they've owned companies more than 5 years. A lot of refinancing there. The global industrial renaissance is alive and well in the U.S. with the delay in deploying the CHIPS Act, a lot of financing onshore of chip manufacturing and other assets. I've been traveling around the globe quite a bit. Japan's still quite interesting from a insurance perspective, from a global wealth perspective, and a PE perspective. And we cannot forget about Europe. I mean, Europe really is what's going on there. It's a once in a generation. I do believe that there's a variety. When you look at a 30 trillion economy in the U.S., 24 trillion in Europe, there's a massive amount of financing to occur.
You've been traveling too much. It's good to have you back.
Good to be back.
Welcome back to New York, Jim Zelter of Apollo Global Management. Jim, thank you, sir.
Always. Thank you.
Appreciate it. Port of Los Angeles Executive Director Gene Seroka with a word of caution, telling the Wall Street Journal, quote, even at a 30% tariff with a 90-day reprieve, it's not going to dramatically change what we're seeing now. Gene Seroka joins us now for more. Gene, welcome back.
Good to see you, John.
Tremendous feedback the last time you were on, so thank you for your time once again, sir. Let's talk about what you are seeing now. What do you see now compared to what this looked like, say, 12 months ago, a month ago?
Yeah, last time we visited, I talked about a quick drop in cargo. We saw that last week, down by more than 30%. The balance of the month seems to be holding, unfortunately, to be down maybe 25% compared to year-on-year stats. Canceled sailings, 17 out of a scheduled 80, still off the books.
So you've got a 20 to 40 day forward look just based on shipping times. What leaves China now arrives in 20 to 40 days. How has that changed in the last few days off the back of, let's just say, the easing tensions over the weekend?
Just last night, talking to some of my friends in Hong Kong and Singapore, bookings or reservations have ticked up, but it's going to take the liner shipping companies a few weeks to reposition vessels in places like Qingdao and Shanghai, Xiamen, Yantian. Pick up some of the products that have been manufactured and sitting, and then another 2 weeks to get to Los Angeles before we try to distribute throughout the country. So while we're starting to see some momentum, a lot of what's taking place here in the States is the finance game. Does it make sense at an average of averages, 30% tariff to start bringing in products? And what will the American consumer's willingness be to buy?
So Ryan Peterson of Flexport came out and said there's going to be a shipping boom with all of these ships coming to the fore that have been waiting to come to get some clarity on tariffs. Sounds like you disagree. Why do you think that it's not going to result in a shipping boom to make up for that month, with the fact that it's going to be more expensive to make it, say, in the U.S. rather than just pay the 30% tariff from China?
Now, there's a lot there, Lisa, as we've talked about before. Number one, let's pick up some of the product that's already been manufactured, sitting on factory floors, warehouses, and in containers. Get that flow going again. The manufacturers in China have got to get their folks back to work. And there'll be a considerable look at Southeast Asia, albeit at 10% tariffs is where we can go. But this 90-day reprieve, as you know, is not a long runway. That's typically the amount of time it takes for a procurement person here in the U.S. to put an order in, get the goods made, and get them on a ship in Asia.
Which raises the question, does that 90-day pause do enough to make sure that shelves are not empty, say, when back-to-school sales period comes around?
We're cutting it so close. Spring fashion has already passed us by. Now you're talking summer fashion, back to school. May is typically the month where purchase orders go into Asia for the year-end holidays. So now folks are kind of rolling the dice a little bit. Do I buy now at these kind of prices? And remember, when I say an average of averages, not every commodity is a 30% tariff. There are some that are extremely high compared to that, and this is cumulative on top of tariffs that have already been put in place. So once again, what's consumer sentiment? How much do I buy, and how much stock do I get out there?
This is a huge problem. Buyers don't know what to buy, and producers don't know how much to produce, even though we've moved the tariffs over the weekend once again.
So do you avoid the paralysis that many people were complaining about when businesses had no idea, or does it just really ease things on the margins but still create some big lapses? And that really is going to be something that we're not going to see for a couple of months.
Gene, as you look at trade flows, can you describe how things have changed? Whether shipping routes have begun to go somewhere else, whether people are starting to think more about air freight than they are just using traditional shipping. How have things changed from your vantage point in the last few weeks?
A lot. And it's about what do we need just to get by over these weeks and months ahead. And going back to 2018, China was 60% of our business at the Port of Los Angeles then. Today it's 45% and dropping. The folks on the ground in Asia are telling me you'll start seeing even more migration of manufacturing and sourcing to Southeast Asia and beyond.
So the likes of Malaysia, the likes of Vietnam, is that where we're looking to things to shift?
Thailand,
Indonesia?
yes. And of course, a lot has been talked about India. But remember that just last year, China exported about 250 million container units. India, about 20 million.
There's a question not only about manufacturing the goods that will come over here, but also manufacturing the ships. And we know that that's been a huge focus of this administration and potential fees on ships that have been built in places like China. How have some of the proposals like that affected your business?
All right. First thing is, it's another fee. It's another charge that the liner shipping companies say will be passed on and ultimately get to the factory level or consumer. But I'm really pleased with the way the U.S. Trade Representative and that office responded. There were more than 500 public comment letters, 2 days of hearings in Washington back in March to talk about what this fee would mean if implemented based on the draft form, which was $1.5 million for every port call in the United States for a ship that was built in China. Now it's on a tonnage basis, vessel voyage, albeit additive to cost. It's a lot better than it was. So the feedback was really heard by the administration.
I'm listening to everything that you're saying, and it sounds like a lot's going to hinge on how much companies believe they can pass along higher prices to consumers. What, from their perspective, given your conversations with them, do you think they'll be looking for in retail sales, in Walmart earnings, to understand just how much power they have to increase prices on consumers that, yes, are tired but are still spending?
I don't know if I can answer all of that, but what I'm hearing on the ground is, okay, prices go up, tariffs, other fees, et cetera. I'm first going to talk with my manufacturer about the cost of those goods, the landed price, and we'll see what we can negotiate. Second, how much do I gain from efficiencies at my company? Can I get smarter and sharper? A little bit of margin compression maybe, but I've got to deliver on that cost saving side. And then thirdly, what can I pass on? If I'm a parts supplier, that cost goes straight to the factory. If I'm a retail finished goods person, it goes to the consumer. So there's still a lot to be worked out. Chances are, with what we know, lower inventories, fewer selections, and higher prices.
And this is why Walmart could be so interesting in a few minutes' time.
Because they've already said they want to compete on price, and they're going to take it probably somewhere else. And it also points to how much they're going to make their suppliers eat as well. So margins all around get compressed in order to offset some of what gets passed along to consumers. The fact that it comes an hour and a half before retail sales gives you a sense of the 1-2 punch, what companies are doing, and then how much appetite consumers have to keep on spending.
We know how consumers feel. What have they been doing? We'll get retail sales at 8:30 Eastern Time. Numbers from Walmart. That stock is up by 0.7%. Numbers from Walmart in about 5 minutes' time. I'm just shocked I said route and not route.
Welcome.
Been here too long.
Welcome.
Been here too long. I did that for you, Gene. It's good to see you.
Thanks, John.
Gene Seroka there of the Port of Los Angeles. Nela Richardson can take a look at things. She joins us from ADP. Nela, welcome to the program. Do your best. What's going on here? Give us a clear picture of what's happening in the U.S. economy.
Good morning. It's mixed, and I think that's what you're seeing in the data. Now, if you're looking really for some good news on inflation, you found it today, and that is the through line. And also, if you're looking for good news on the labor market, you see it continue. So those initial jobless claims still at historical lows, that is helpful for an economy built on consumption. But when you turn to the consumer and you bring in that soft data of consumer being downbeat, and we know that consumers went out and they stockpiled on durables, on cars and vehicles. What we're seeing in April is a moderation from that stockpiling, and maybe starting to really reflect new economics vulnerabilities. We left the last Fed meeting with two risks at our disposal. We left the risk of slower growth and higher inflation. And I think that's what the markets are really focused on. That higher inflation risk looks a little less risky today, but every day is a different day when it comes to this economy right now.
Nela, I'm pleased you brought up that topic because I think it's so important. It's been really difficult to try and unpack what is just a front loading of purchases by consumers versus what is genuine, authentic, durable, sustainable demand. And as we work our way through the summer, we've been trying to work this out all morning on this program. Are we going to see the price increases? Is Walmart the one to listen to? As they warned this morning, they can't hold off much longer from here, Nela. How do you gauge that at the moment? What do you look at?
I think the large retailers should be listened to. They are active in this market. They are seeing the prices in real time. Also, consumers are important to listen to in this moment. When they say they're downbeat, they mean it. We don't talk a lot about consumer surplus, and just really quickly from your Econ 101 class, it's the price consumers are willing to pay versus the price they're actually paid. But if consumer surplus is being eroded because they're seeing higher prices, that means consumers will continue to feel downbeat. And those feelings are translating right now into what a data point we'll see on Friday, which is consumer sentiment. And if that continues, it really does reflect that higher risk of continued inflation that the Federal Reserve warned about a week ago.
And this is the reason why, Nela, a lot of people say we don't know how relevant any of this data is because we don't know whether this is just April data and people feeling bad in April. But in May, things are going to look a lot better because we have a reprieve from some of the tariffs and things are looking a little bit easier. The market is rebounding. Nela, how do you look at the quickly moving policy and then judge the relevance of any of this data that is just a snapshot in a very quickly moving movie?
I look for the steadfast, stronghold in the economy, and right now that's the labor market. The labor market is solid. If you look at initial jobless claims, if you look at the pace of hiring, though we see it at ADP to be more modest than it has been in the past, it's still solid. We're still seeing strength, and that is the underpinning of the bulk of the consumers. So as long as the labor market stays strong, stays solid, we still see growth in jobs, we still see wages above inflation, then you have an economy that could weather some of these higher level risks.
How much, Nela, do you see because of that stability in the labor market, in addition to what we are hearing from some of the biggest retailers in the world, that prices are going to go up? How much is a stagflationary-like environment becoming increasingly your base case for the remainder of this year?
It's a risk. It is a risk. I think what we're seeing, collectively in all this data is an economy that looks to be slowing a bit. I mean, the first quarter contraction is also messy given the high degree of imports. So it's again, a backward-looking data point that was based on a lot of stockpiling. But looking forward, if growth slows, not just because of U.S. consumption and U.S. production, but also around the world, if growth is at risk, then you might see slower growth and higher prices. So yes, stagflation is increasingly a bigger concern. In my mind, it was always a concern. I think the dynamics that kept inflation down for 4 decades going into the pandemic have changed dramatically. We don't talk about these longer trends that are affecting inflation. So even without trade policy, that was always a risk. Now that risk is amplified because of some of the uncertainty that we're still seeing on the trade side.
Nela, thanks for jumping on. Thank you very much. Nela Richardson there of ADP.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.